Are you expecting like a bounce back to the economies? I mean, a lot of businesses I know have struggled, a lot have gone under. Some are going to need finance and loans. Some of the ones that have gone under are going to be replaced by new businesses. But are you expecting some kind of economic boost?
Yeah, my overall base case is for pretty high nominal GDP in 2021 because you're coming off really weak base effects. So when you do year-over-year comparisons, it can be pretty high. And then also, yeah, you have that surge of kind of there's certain types of demand that are pent-up demand and certain ones that are not. And so, for example, restaurant demand is an example where for the most part, it's not pent up because you can't go back and replace all the meals you missed, right? You can go and you can have a couple extra meals for a few weeks and people get that out of their system. But some of that economic activity was lost forever. Whereas like travel, for example, you might have like people want to say, I want to take 2 trips instead of 1 trip this year. You might have, more kind of travel like that. And so overall, I do think that we're likely to see kind of a spike up. And that's when it gets interesting because countries around the world did these massive fiscal stimulus packages. The bonds were in large part bought by the central banks, and so that directly increased the broad money supply. And so when you have that kind of, but it's been offset by a reduction in economic activity, a reduction in velocity of that money. So if you have an uptick in economic activity and velocity with that increased monetary, kind of amount of money in the system, that's when you kind of get like an inflationary spike. And of course, countries did it at different rates. So the UK increased their money supply by something like 10% year over year, whereas over in the States, we boosted our money supply by 25% year over year. We've been like the cowboys of the money printing, and so we'll probably yeah, we'll probably see it at different rates around the world, but it's going to be fun to watch. One of the things we're watching now over the past week is we're seeing a rotation. So the overall index is kind of it's sagging a little bit, but under the surface, you're actually seeing really big moves, which is you're seeing some of the unprofitable, extremely highly valued tech stocks that have done extraordinarily well in 2020. I mean, a lot of them are up 100%, 200%, 300% year over year. A lot of those are sagging really hard, whereas you have things like bank stocks or energy stocks surging. And of course, energy is surging because energy prices are going up because we've reduced supply and demand starting to kind of return a little bit, and so they're liking that. And with bank stocks, they benefit from a steeper yield curve. So when the 10-year treasury, the 30-year treasury, when they go up, banks like that because their business model is based on borrowing at the short end of the curve and lending at the long end of the curve. And because also, higher, 10-year, 30-year bonds, that should, keep up mortgage rates and things like that. And so you're seeing that rotation from basically growth to value, things like banks and energy. And so if you were to get higher and higher yields, that should continue that rotation. And one of the things about the United States market is that our S&P 500 is very kind of tilted towards those growth tech names, and so it tends to be kind of worse for us if we have that rotation. Whereas UK, if you look at the top, it's like energy companies and commodity companies and some financials and things like that. It's a little bit more value oriented, and that's generally a rotation we're seeing. Well, there's a couple things. One is some of them, for a while, until we're getting these kind of institutional custody solutions, they couldn't invest in it even for regulatory reasons, regardless of size. And so I talked to investment managers that were like, yeah, we looked about self-custodying, but we can't self-custody investments. And so, for example, they were using GBTC, the Grayscale Bitcoin Trust, as their way to do it. But now we have the build out of Fidelity. We have some of these other like NYDIG or Skybridge, some of these other institutions that are coming out with institutional grade products. It's basically the on ramps for institutions to put it in are much easier. And so yeah, we basically have been in a situation where liquidity's been an issue. Even if you were going to invest and if you're running $100 billion fund and you want to put a 1% position in, they're worried that $1 billion purchase is going to move the market. And of course, back when Bitcoin was $100 billion, and then the percentage of that was actually liquid was lower, that would move the market. And now we're seeing that for example, Michael Saylor can do billion-dollar purchases, and he probably moves the market a little bit, but you're not really sure. Like you're kind of watching it, and you're assuming he's probably in there buying, but as long as they do it smart and they spread their purchases out, it's basically a liquid enough market that you can absorb billion-dollar purchases now. And so basically that that $1 trillion threshold and that liquidity threshold, that really kind of does make it a macro asset, and so it's basically somewhat normalized, I think now over the past year, for some of these institutions to have a non-zero Bitcoin position. It doesn't sound like they're wacky. They're not going to get like fired for even recommending it.
Do you think that's going to lead to a little bit more stability in the pricing, or do you still think we're still going to suffer from the volatility?
Well, my base case over time is that as it becomes a bigger and more widely held asset, that its volatility should go down. And we haven't really seen that too much so far with the post-halving cycle drawdowns. But if you look at things like market cap versus realized cap, each cycle has been, by that measure, less volatile than the one before it. And so my base case is that that would continue, and that if you see more dispersion among including these institutional holdings, that you're likely to get a little bit more stability there. And as an example, I mean, I hold Bitcoin in multiple different ways. So for example, I have the cold storage holding, but I also have portfolios that some of my members and clients kind of look at it and kind of use for their own inspiration. And so for example, in those brokerage accounts, I'll have something like GBTC as my Bitcoin allocation, just because that's the option that's available in that sort of account. And I've done occasional trimmings to basically maintain that below a certain threshold, because it's not like there are people that actually follow that and have to kind of maintain the volatility at a certain level. And so there's certainly other portfolio managers like that are doing a similar thing, where they might have had a 5% Bitcoin allocation, and then it ballooned to like 20%, and they have to reduce a little bit. But then on the same token, if you were to get a big sell-off, you might get some of them come in and say, okay, we got to boost up our Bitcoin allocation because we're going to rebalance. And so if it becomes that more widely held asset, it benefits from that rebalancing cycle.
Okay, you can explain something to me that nobody's done in a way that I've been able to understand yet. Can you explain the GBTC premium to me?
So DBTC is not an ETF. It's a closed-end fund, and so basically they don't quickly issue more shares as needed in order to maintain their NAV, premium above NAV around zero, like an ETF would. And so basically, if you look at a closed-end fund,
I think even that you need to. I'm thinking about like other people who don't know this. Can we explain what happens with an ETF then? Like, can you explain that like in like on 5?
Sure. So it's probably simpler first to explain closed-end funds that don't do that. And so a closed-end fund, they've been around for decades. And what they'll say is, okay, this manager is going to go ahead and buy like 20 stocks, and they're gonna do initial public offering, and they're gonna take in $1 billion, and they can use that $1 billion, and they're gonna build a portfolio of stocks. And then basically that portfolio now trades publicly. You can buy it's basically organized as a company. And so you can buy shares in that company, and all that company does is hold these stocks. And what's interesting about that is that that company is not necessarily issuing more shares. They're just, there's a certain number of shares outstanding, and they hold investments in their account. And at the end of the day, you can look at all their investments and calculate what their portfolio is worth. If you just kind of add it up, that's their net asset value, or NAV. And then the market can then price those shares or whatever it wants. And sometimes it might say, okay, even though we've done the calculations and all, if you add up all the investments that company holds per share, it's $25 a share. But we want to get in on the action so much. We really like that manager, so we're going to pay $28 a share. And so you're basically paying a premium over NAV. On the other hand, most closed-end funds trade at a discount to NAV, because it basically makes it so that they, because that fund charges a fee on the investments. And so if you basically trade at a discount to NAV, you're basically factoring out the fee, essentially.